So if you do, one of those three things, if not all three things, you should increase your NOI. And the reason that the NOI is so important is that's how apartment and multifamily is typically valued, right? The NOI, so the income that property produces, paired with the cap rate, or in other words, what someone is willing to pay for that income, given the vintage, given the location, given the business plan. And those things are or at least they should be non-operator or non-owner specific. Welcome, everybody, to today's episode. We're going to be discussing how to optimize your portfolio for maximum returns and minimum headache. And with us today, we got Ed Monarchik, Viking's very new, but also very experienced asset manager. So welcome, Ed.
Thank you. Glad to be here.
Awesome. So we'll dive into pretty much all things asset management. But first, I want to give our listeners kind of a background. How'd you get to where you are? What's your story? Where'd you come from? And how did you kind of find your place at Viking?
My name's Ed Monarchik. I am the Director of Asset Management, and I have been in multifamily real estate for quite some time. I started out on Wall Street and realized somehow I managed to get into real estate and multifamily. Not everyone sets out to be in multifamily, but I just sort of ended up there. I started my first job in multifamily back in acquisitions with a company called Maryland Investment Company, which was a multifamily REIT that came out of the RTC days. And from there, I got into asset management with Equity Residential. Spent a long time in development, merchant build development, luxury multifamily properties with Zom and Lane Company, back into asset management with Tribridge. And most recently, I spent about 10 years with a company called Mesa Capital, and we did value add apartment communities throughout the Southeast, about 50 of them. And I like to say I've seen it all in multifamily, but every time we do one, there's something completely new that we see. So I'm glad to be here. I love the strategy here at Viking Capital. I think it is perfect for this time in the market, and look forward to doing good things.
Yeah, no, we love the wealth of experience that you bring to the table, and appreciate the time that you took out today to really kind of inform our listeners of everything asset management. Because there's a lot of talk about acquisitions and capital raising, but really, for any kind of investment company, especially one in multifamily real estate, really the bread and butter is the asset management and how the property performs throughout the whole period, not just kind of that front end process. So, during that process where we are finding a deal and we kind of bring it to the asset management team, how do you assess whether a property aligns with Viking's investment strategy and with kind of the overall health of our portfolio?
The first thing I look at is Real Estate 101, which is the location of the property. It's critical that the property is near job growth, what retail is in the area. One of the things I look at, it's somewhat simplistic, but it's often overlooked, is where are you going to shop? Where are you going to go to restaurants? What are you going to do? How attractive is the area? And I look at the age of the property. Is it built in the 1980s? Is it built in 90s? Is it a light value add? Is it what I would call a heavy value add or a full value add type property to upgrade it to the market? I like to look for a property that is inferior to the market, but has good bones. I like to say that if we take it to the next level, improve the condition of the property, we look at the exterior of the property. How does it look if we give it a facelift, if we improve deferred maintenance, and we upgrade the interiors to a condition that it elevates it up to a property level that's either at where it should be or better than where it should be in the market. And we evaluate whether it's what type of interior upgrade strategy we would pursue. But the goal is to find value add opportunity, operationally efficiencies in the exteriors, amenities, often overlooked because people people come into the clubhouse, and nowadays a lot of people don't pay attention to the clubhouse, but it's actually pretty critical to create an experience for folks. And we look for opportunities as well for properties that have opportunity to generate income in other ways, such as technology and stuff like that.
Yeah. Yeah. I love that, top down, but also a holistic approach, because especially at least on the acquisition side of things, we can get pretty caught up in all the details of the finances and kind of the debt that we're going to place in the property. But I love how you're thinking, hey, what's the vintage of the property? How's that going to affect my repairs and maintenance and my turn costs or my CapEx budget, right, for these major projects? Also taking a look at the location, and is it a B class property in a B class area, or is it an A class property in a B class area? What kind of demographic are we serving, even down to the tenant level? What is that experience going to look like? Where are these people going to shop? Where are they going to send their kids to school? What kind of transportation is nearby? And then how can we tailor our business plan to really serve that demographic? So love kind of your perspective even prior to acquiring a deal. So during the due diligence process is really where that handover between the acquisitions department and the asset management department really, they almost kind of dance with each other, right? Where we've found a property that we have acquired and thinking, hey, this is a good property and we want to buy this deal. And then we get into the due diligence phase and we start to ask ourselves, hey, what would make us not want to buy the deal, right? What kind of skeletons are hidden in the closet that would turn us away from the deal? And it's really during that due diligence period that we have the time to really kind of dig in and lift the carpet up, so to speak, and see what kind of spiders are hiding underneath. So what are the most important elements that you look at when you're conducting due diligence? Again, keeping in mind how this property fits into the overall Viking portfolio.
Mm-hmm. Well, during the due diligence period, we look at a large amount of areas. We look at everything from the exterior of the properties, the condition, deferred maintenance, all the way down to the financial operating statements, the rent roll. We have a checklist that we go through to make sure that we are looking at everything, but it would include as from an operational standpoint, all the financial statements. We also look at leasing and operational traffic. We look at are they offering concessions in the market? We look at the market surveys to see what kind of rents they're charging, service contracts. We look at cable agreements. We look at the insurance. We look at the taxes on the property. And then there's capital expenditures, a whole list of things.
Yep. And they typically fall into 3 different buckets, right? You have your physical due diligence, right? Actually inspecting the property itself. You have your financial due diligence, which is looking through your past financials and your leases, and you have your kind of legal title due diligence as well. So that's really kind of pre-acquisition. But once we actually acquire the asset and that handoff really does take place, what are kind of the first operational areas that you focus on improving? Because once we acquire the asset, that's when the clock starts ticking for our hold period. Now the asset is completely in our hands, and it's up to us to perform to our pro forma, if not beat our pro forma. So what kind of the first key operational aspects that you look into, or is it more of a deal by deal specific process?
There are a couple of things we do immediately, and then it is very much a deal by deal process. But there is an overall strategy that we employ. The first thing we look at is what are we inheriting? What are we inheriting in the rent roll in terms of delinquency? Who's living on the property? And we go from there. And then the next thing we would do is evaluate the on-site personnel. Often that is the most overlooked part and the most important part of taking over a property is, do we have the right people in the right places to accomplish what we would like to accomplish from a value add perspective, and are they able to align with what we would like to do? And once we determine that we have the right staff in place, then we start executing on the strategy, improving the operations. We will bring in the capital folks to do the exterior renovations, Usually the property management team will help with and oversee the interior renovations, and we'll start with about 5 unit interior renovations and get those online in about 45 days. And we will start the amenities, we'll start interior design. And the idea is to have that all come together within 6 months to basically create a sense of place. And once that place is established, we all the while we're going through the operational efficiencies, making it better as we go, implementing best practices in terms of property management. And then the exterior comes together, the interior comes, and when I'd say 6 to 8 months, we have that sense of place established, and the interior renovations are proceeding along.
Yep. Because it really is those value add components that are really driving the value of the deal, right? And I love how you touch on the people aspect of it too, right? Because you could have said, hey, we're going to cut the R&M budget by 50%. We're going to cut payroll and leasing, but ultimately it comes down to that property management and that staff that's on site, because those are going to be the ones that are really day in and day out that are completing and moving that needle forward on your business plan. So when you're talking about, a value add plan, how do you determine the scope of the renovations and the budget for the renovations to make sure that you have, enough capital to actually complete the renovations on a timely manner and really move the needle forward as quickly as possible?
We will determine the scope of the renovation and the cost of the renovation prior to acquiring the property. So we will know through the due diligence process and inspections what condition of the units are that we're inheriting, whether it's a partial upgrade or whether it's a full upgrade. And we do have a predetermined spec for Viking Renovations, although it will vary depending on the market. We'll shop all the comps, we'll know exactly what they're doing and how we position relative to it. And we have a good idea what it should cost, but relative to what we market in, it may have varying costs. But that is usually determined prior to acquisition. It does vary during acquisition depending on market conditions, but usually we're pretty close on that in terms of being able to execute on the cost and the specifications.
Got it. Yeah, and what's especially important during that value add process is that you stay on track and that you stay on budget, because those two things are really kind of what will drive the value add business plan forward, or can really derail it too. If you are off on time or off on expenses, that can get out of hand pretty quickly. So what KPIs or metrics are you monitoring on a pretty consistent basis to track the health of one a specific asset, but two, also the health of the overall portfolio, either in that specific geography, in that specific location, or over the entire Viking portfolio?
Yes, I look at KPIs weekly with the from an operational standpoint, and I try to look at leased occupancy versus physical occupancy. I like to see that the 60-day trend is usually about 2 to 3% higher than what the physical occupancy is. And I also look at economic occupancy versus physical occupancy. And economic occupancy includes concessions and any discounts that are given to the rent. So economic occupancy is telling you what is actually collected versus what is rented. I look at actual collections, cash in the bank, which is what I consider the number one indicator of where we're headed. How much cash in the bank do we have on a month-over-month basis? That's a monthly figure, but on a weekly basis, I tend to look at physical versus economic, and lease versus physical, and collections. I also look at monthly budgeted NOI versus actual NOI, and track it versus pro forma. One of the big key indicators I look at monthly is total revenue. Because usually in a value add type property, you're usually, when you first acquire it, you're cleaning up a lot of expenses. So to focus on expenses right out of the in the immediate what I call the first phase is not where I really put my attention. It's more of a cleanup, get it right, get it in place on that side. But it's really about driving the revenue, because once you drive the top line revenue, you can kind of peel the expenses into where they need to be. So often, and this is a good point, is you'll see the NOI be very erratic in the first year of an acquisition. it won't be stable because you're encountering some skeletons in the closet. You're encountering expenses that are what I call one-time expenses that will not be there after you've done it once or twice. You fixed it; it won't show up on the operating statement going forward. So we often get a lot of questions on why is the NOI negative, or why did it bump, or why is it like this? Well, the answer to that question is because we're in the cleanup and execution phase. So what I'm looking at predominantly is the leasing activity and revenue growth and collections growth. And then as we pass the 1 year mark, then we turn our attention to a lot of operational efficiencies.
Yep. And especially when it comes to the NOI, we've raised most of that capital up front during the acquisitions process. So even though it is technically an expense, it's not necessarily an expense that's being deducted from the NOI since that capital is already available pre-acquisition. So I want to touch on a little bit what you said about the NOI, because the NOI is really important to understanding the valuation of an apartment. So for those of you who don't know, NOI stands for net operating income. So in simplistic terms, it's the income from the property minus the expenses of the property. And there's three kind of main ways that you can really drive or increase the NOI, right? One of them is going to be to increase the revenue via those renovations and the premiums you can get for those renovations, or by finding other sources of income, whether that be adding in carports or renting out the clubhouse, for example. So that's how you increase the revenue. Second way is to minimize your revenue loss, right? Through either vacancy, concessions, bad debt, which is revenue that's considered as uncollectible. If you can minimize those, you actually collect more revenue. So those are the two kind of on the revenue side of things. And the third, as we mentioned, is to reduce the expenses. So if you do, one of those three things, if not all three things, you should increase your NOI. And the reason that the NOI is so important is that's how apartment and multifamily is typically valued, right? The NOI, so the income that property produces, paired with the cap rate, or in other words, what someone is willing to pay for that income, given the vintage, given the location, given the business plan. And those things are or at least they should be non-operator or non-owner specific. So they are purely valued on how the property is performing. It does not take into account your debt or your reserves or those capital expenditures, those large projects, because those are all very owner specific expenses. So that's why the NOI and the NOI growth is so important. And that's especially important when it comes to either refinance or a sale. So Ed, can you kind of walk us through how you determine the most optimal time to either refinance or sell an asset?
Yes, there's really, it comes down to an optimal time from an operational standpoint, and there's also could be an optimal time from a market standpoint. Cap rates and interest rates could move in your favor significantly and increase the value of the property just by the fact that the market conditions are moving in your favor. And you can the other aspect that I look at, that I drive, because I can't really control that, but I can control the operational efficiencies of the property. So I look for when is the optimal time. Obviously, I'm driving that revenue towards pro forma to exceed pro forma. If we're exceeding pro forma by a significant amount on the revenue, which usually filters down to the NOI once we get it stabilized and the operational efficiencies are there. If it's exceeding pro forma, it could be an opportunity to sell it early. If it's tracking pro forma, then it probably would be in year 3-ish, 4-ish, right in there, when it would be about time to look for a sale based on an operational pro forma. But like I said, it could vary depending on market conditions. It also could vary on job growth, if job growth comes in slower or higher. So you have to be ready to show that income trend and show that NOI growth. From a sales standpoint, I would want to show about 6 months of increasing NOI and increasing revenue growth, and have a good track record on the amount of renovated units we have, so that we can sell a story that there is still a little bit of renovation left. There's still some upside to the next owner of the property as well. There has to be a little bit of what I call meat on the bone for the next group, so they'll usually come in and say, I can operate it better, I can do this better, but I like to leave a couple things there, some renovated units or some other things that they can put in their underwriting. So,
yep. And you want to have optionality too when it comes to refi or sale, right? You don't want to be forced to sell either because, the property is underperforming or your debt's coming due. So, part of the asset management's roles and responsibilities, especially during the hold period, and especially once the property is stabilized, is to really set it up to refi or to sell if it is your business plan, to have that optionality, right? Because if the property is cash flowing well, you can really kind of wait and time the market. There's always that famous saying, you can't really time the market. It's better to be time in the market than to time the market. But at least you want to have optionality to say, hey, if I am, seeing that cap rates are compressing, rental growth is strong, occupancy is stable, now's a great time to sell. You want to have that optionality rather than being, again, forced to sell due to, underperforming assets. But if an asset is underperforming, how do you, one, diagnose the issue, Ed? And then two, what kind of processes do you do to turn that ship around to get it back on track?
If it's underperforming, it's going to show up in the weekly metrics, and it'll show up that's where you'll first see it, and it'll show up what I call on my watch list properties. And those will diagnose what the issue is, whether the issue is we're not getting enough traffic, whether there's a submarket issue, whether it's bad debt. It could be anything. We could have an external event, a weather condition or something that causes some down units or whatnot. There are various issues that could cause an asset to not track to performing, but the key is to diagnose it, to understand what it is and how we get it back on track. I've rarely ever had a property that has steered off to the point that we can't get it back on track. The key there is to understand what it is, diagnose it quickly, and head it off as a team effort from an operational standpoint.
Yep. And you always want to, right? The whole point of tracking those key KPIs is that so you can see those issues coming, down the fairway, so to speak, right? So you aren't caught off guard. So you're not, caught with your pants down, so to speak, right? So tracking those KPIs on a weekly, monthly basis really kind of sets you up and allows you to pinpoint issues even before they get to your kind of front doorstep. So when I'm talking about, investing either as an investor myself or on kind of the more active side, a lot of it is about risk management, right? Do the returns of this deal match with my investment strategy, but also my preferred risk profile, right? Because different risk profiles will have different returns. But what systems and practices do you implement at Viking to really kind of manage that risk across the entire portfolio and kind of minimize downside risk?
Well, that depends. It could be, for example, we use a lot of exterior consultants, such as we have a tax consultant that's all they do is they're experts in real estate taxes and how they're monitoring that for us. And we also have insurance consultants. Not only do we have an insurance broker, but we actually have a consultant that works for us from an owner's perspective and evaluates that from a risk management perspective. Part of risk management is the property management team, the team that's like First Communities that is managing our properties right now is a risk management because they have a platform in place that they execute on. Internally we have our own risk management practices in terms of monitoring weekly, monitoring monthly, and all that combines together, and even using external contractors, the same ones that we use on multiple projects and multiple times, so that we know what we're going to get finished product, and we know from an internal value add what we're going to get, and we also know what we're going to get on the external. So the less unknowns, the better as we go through the process.
Yep. And that's also why we engaged asset management and our property management teams very early on in the acquisitions process. Sometimes they even, tour the asset for us, is because we want to have that handoff be as seamless as possible, right? We say, hey, here's an asset that we are thinking of acquiring. We want your eyes and your expertise, and to Ed's point, your we want to hit the right people in the right seats, so that when that transition does happen, post closing, we can hit the ground running, and that in turn minimizes the risk, because you've already laid eyes on it. You've already taken a look at the operating, expenses, the budget, the business plan for the renovations. So again, kind of going back to that analogy of seeing things down the fairway, seeing things through your car window, if you will, you're able to see it before it actually hits you, right? So,
Yeah.
what last question for you, Ed? What kind of piece of advice would you give to an investor who's either looking at a pro forma or looking at a business plan, and is kind of really relying on the asset management team that they're investing in to perform expectations? What kind of advice would you give to an investor if they're looking at a deal for the first time, to really kind of pinpoint the asset management success or potential risk that they can then ask the sponsor?
If I was an investor looking at the deal, I would look at the return relative to the risk, and I would also understand that as we go through these projects, that they're in the first year there's ups and downs and all arounds, but I would look to see what it looks like in year 3 and year 4 in terms of cash flow, cash to the investor, and in terms of ultimate exit strategy.
Yep. And that's why some operators choose to focus on stabilized cap rates, stabilized yield on cost, because after we all know that during those first few years, especially if it is a value add plan and a big one at that, those first 3 years are going to be not as stable as years 4 and 5 when you go to sell the asset. So a lot of the pitches when you're looking at OMs, for example, or even investment decks, will say, hey, stabilized cap rate is 6-7%. And what they're saying is, after we've done the value add business plan and after our asset management team has stabilized the asset, this is really kind of the yield that you can expect on a much more consistent basis than during those first few years. So, Ed, I really appreciate your time, your expertise. We love having you on the team. Hopefully this is a very long journey of working together. Any kind of last bits of advice before we sign off?
Gotta stop again. You're nailing me with these last bits of advice, man.
Maybe like something that you learned along your asset management journey that you didn't know from the start, or kind of like tips and tricks that you picked up along the way that no one really talks about, something along those lines.
From an asset management perspective.
Yep. Or you can even say like a story about your most difficult property and how you got under wraps.
Okay, I'll do this one. All right. One tip of advice I would give would be always trust but verify when it comes to your staff, what's in place, what's going on. I can think of an example one time where I was building a high rise in Hollywood, Florida, and we didn't double check the survey because we thought the surveyor did it right. He had the building 6 inches in the wrong spot and on the property. But when you build a high rise, 6 inches is a big deal. When you build a garden apartment community, 6 inches, who cares? Well, we were 6 inches into somebody else's property and we had to go through the process of buying it. So I would always say trust but verify. So put good people in the right seats, let them do their job, let them do it well, but always circle back around and make sure things are working the way they're supposed to.
Yep. I love that. Trust but verify. Because ultimately those third parties are working for you as ownership, and the buck stops with that ownership group. So even if you hire all the right third parties, all the right surveyors and environmental reports, and you get your general contractor on site, ultimately at the end of the day, the ownership group is the one that's beholden to the investors, the property management team, the residents. So it's not a responsibility that we take lightly. But I appreciate your time, Ed. Thanks for jumping on. Hopefully this is not the last time that we had to talk about asset management, because I love this kind of stuff where we dig deep into the details. So thanks, Ed.
Yes, thank you. Appreciate it. Glad to be here.